So it is Saturday, and we are going to be talking about money here on The Answer About Money. I've been poor, and I've been rich, and rich is better. Bernice Kaufman is credited with saying that back in the 1800s. It's been credited as well to Mark Twain. It's been credited to any number of people. I've been poor, and I've been rich, but rich is better. I hope if you're listening to this program that your focus is not getting poor, but that your focus is on investments and increasing the size of your investment. Now, every advisor, every money manager, every investment manager or trading platform will tell you they make money. And the fact is, they do. Everyone will tell you they make money. And almost all of them will, most of the time. They will take $500,000 and turn it into $600,000. And I have no doubts that almost everyone can do that. But what they don't tell you is over what time period. How long will it take? If it goes from $500,000 to $600,000 in a year, that's a 20% per year return. That's great. But if it takes 10 years to do that, 10 years to go from $500,000 to $600,000, that's less than 2% a year. That's not what we're talking about. That's not what I want to talk about today. Today I want to talk about what to do to grow your investment, what you need to do if you're going to play to win, if you're going to invest to win. That's what this is about. And it's not about gambling. We're not here to gamble. We're here actually to win. I want to tell you about strategies. I want to talk about strategies today. 3 different strategies. 3 different strategies. I think they all come to play. And most people define 2 strategies. I want to really talk about 3. Because I believe there are 3 strategies at play today in the market. The first of those is asset allocation. And most people don't talk about it as a different strategy, but I think the focus and what it does is so different from the other 2 that it's worth classifying as a separate strategy. The second strategy, you know it too, it's tactical, it's technical, it's momentum. It's been called by any number of names. It's a tactical strategy. The third strategy is the strategic strategy. Sometimes called buy and hold, sometimes called long-term. It's not just buy and hold. It's strategic. But the approach is very different in each one of these 3 different strategies. And I want to talk about each one of the 3 separately, and I want my listeners to understand what's going on. Because if you don't have a strategy, I think Yogi Berra, the famous New York Yankees catcher, one of my favorite philosophers, what he said is best. If you don't know where you're going to get there. I think the starting point of investing is really to have a strategy. And I believe it's one of these 3, asset allocation, tactical, or strategic. So let's start talking about asset allocation first. And before I even talk about that, I want to tell you that my bias is I am a strategic investor. I invest for my clients on a strategic basis, and I'm going to tell you more about that as we get there. But most financial advisors are asset allocators. That's their strategy. And it's a strategy that depends upon 3 rules. It's just 3 rules. Rule number 1 is don't lose money. Think about that. If what I'm saying is correct, the whole focus is not to lose money. It's not to play to win, but don't lose money. Second rule number 2, is remember rule number 1. The big firms, and even some small firms, the big brokerage firms, the ones you know the names of, they like this rule. Don't lose money, because even if you make just a little tiny bet, even if you make less than 2% a year, as long as you've made money, you can't sue them. You can't claim. But had you done a different strategy, had you been involved in different things, you would have made a lot more money. That opportunity is lost, but the big firms don't mind because they cannot be sued, and they've collected their fees all during that time. That's rule number 2, is remember rule number 1. Rule number 3 is remember rule number 2. And studies show that investors are twice as fearful of losing money as they are optimistic about making money. Twice more concerned with losing money than they are concerned with making money. So it's an emotional appeal. It sounds emotional. I had one person, when I was explaining them to him, said there's a rule number 4. I said, what's rule number 4? Remember rule number 3. That is asset allocation. That is where it is. And it depends on 3 key assumptions. It's a strategy. Don't lose money. And the 3 key assumptions are this. Number 1, they believe that markets are highly, not perfectly, but highly efficient in both the short term and the long term. That means if there's any news, it's already in the market. You've heard it said time and again. When news comes out, that's already in the market. The market's already looking ahead 6 months. What does that really mean? Does the market have an intelligence of its own? Stocks and bonds are inanimate. They have no intelligence. So what does it really mean? It means that somehow the totality of all the people making investments make it perfectly efficient, or maybe not perfectly, but highly efficient, both in the short term and the long term. That's the first thing, that our first assumption for asset allocation. The second assumption is that all unique sources of risk have similar risk-adjusted rates of return. Not similar returns, but similar risk-adjusted rates of return. What does that mean? It means that cash and bonds and stocks all have a similar risk-adjusted rate of return. If you move from one to the other, you may be increasing the risk, but if you adjust the risk out of it, they have a similar type of return. So that is the second assumption. The third assumption for asset allocation is the portfolio should be diversified across as many unique sources of risk as possible. So if one thing goes down, another thing goes up. The idea is absolute diversification, as much as you can possibly do. And if all of this sounds kind of familiar, it should, because this is essentially modern portfolio theory. Modern portfolio theory, that's everything that's involved. And for me, how does it really work in the real world? I think it's pretty simple math. If you take stocks at 9% and bonds that are yielding 5% and cash that's yielding 1%, and you put 1/3 of your portfolio into each one of those, you can get to a solution of 9% in the stocks, 5% in the bonds, plus 1% in the cash. If you add those 9 plus 5 plus 1 together, you get a total of 15. If you divide that by 3, you get 5. So by my simple method and simple math, you get to about a 5% return when you're doing asset allocation. How does it work in the real world? Well, we have some examples. Cerulli and Associates did a study in 2010, 2011, and found that the average return was around 4% for financial advisors. SEI did a study of 750 advisors and found from 2016 to 2018, the average return was 5%. 5%. If that's accurate, 5% over 10 years is going to turn 500,000 into 814,000. remember that 814,000 number. We're going to come back to that later. Remember, I began the program by saying they tell you they can turn 500 into 600,000. It depends upon time period. Here we're talking 10 years to turn 500,000 into 814. That's at a 5% return. That's asset allocation. That's where I believe the strategy is. And when you're doing a financial plan, if you look at financial plans, what do they do in implementing their strategy? They may say it's tactical, they may say it's strategic, but in reality, it's asset allocation. It depends upon those three assumptions, and it really is targeted toward following those three rules. Don't lose money, don't lose money, don't lose money. We're going to come back and talk about the other two strategies right after commercial break, so don't go away. I'll be right back. So welcome back. I've been talking about strategies. If you don't have a strategy, you don't know where you're going. You need a roadmap, and a strategy gives you a way of approaching investing and a focus. And to be successful, I believe you have to have a strategy. I talked about asset allocation. I want to turn to the second strategy and talk about tactical investing. You know, as technical, as momentum, as tactical. The whole focus has three objectives. Objective number one is to be out of the market on the worst trading days. Objective two is to be short on the worst trading days. And objective three is to miss the downturns in the market. That's the focus of tactical investing. And if you just miss the worst 10 trading days in the last 10 years, 500,000 becomes 8,029,884. Think about that. Remember I told you to think about asset allocation prior to the break, asset allocation over 10 years at 5%, 500,000 becomes 814,000. Now think about tactical investing. Missing just the 10 worst trading days turns 500,000 not into 800,000, but to 8 million. That's 10 times what you get from asset allocation. Not one or two, but 10 times. And if you look at the Standard & Poor's 500 total return over that same period of time, over those 10 years, 500,000 grew to $2.2 million. But it didn't get close to $8 million. So just missing an average of one trading day per year can turn 500,000 into 8 million. You've heard this. You've heard Jeff Hirsch on my program. He's the head of Stock Traders Almanac, and I've taken a chart from Stock Traders Almanac, taken some numbers from Stock Traders Almanac. So I want to give him a shout out because the Stock Traders Almanac is full of information. I turn to it every year. I look at it on a regular basis to draw information. So I would recommend, if you're listening to the program, you subscribe to it and check it out. But he's got a chart that shows the growth of 100,000 in the Standard & Poor's from 1994 to 2014 would have grown 100. That 100,000 would have grown had you been invested the whole time to 339,000. I want you to remember that 339,000 because we'll revisit it later on when we talk about strategic investing. It goes up to 339,000. But if you miss the 10 worst days, it goes to 844,000. If you'd missed the best 30 days, it would have grown to 2.4 million. And if you had missed the worst 50 days in that 20 years, an average of 2.5 days per year, that 100,000 would have grown 50-fold to 5,100,000. Think about that. During that 20 years, the Standard & Poor's grew at 7%. If you had missed just 50 worst days, it would have grown at 22%. 100,000 would have grown to $5 million. And that's the attractiveness of tactical investing. If you can miss those days, it can grow to that amount. The issue in my mind is the competition. If you look at what it is, If you just look at the number of hedge funds that have existed, in 1995, there were $300 million invested in hedge funds. By 2020, that had grown to $3 trillion. 300 million to 3 trillion. That's a 10,000-fold increase in hedge funds. Now, not all of those are tactical, but a good portion of those are, in fact, tactical. That's the kind of growth. That's the kind of competition it attracts. If you look at mutual funds, and a good majority of mutual funds are invested in tactical investing. And I'm talking just about stock mutual funds. In 2000, there were $3 to $4 million, $3 to $4 trillion invested in mutual funds. By 2019, that had grown to 15 trillion. So when you add those together, that 18 trillion in hedge funds and mutual funds, and over half of it is invested in tactical investing, you can begin to see the amount of competition that is invested in tactical investing, trying to miss the worst days, trying to short the worst days, trying to stay out of the market during downtime periods. That's the focus. And I want to give you an example. Bridgewater Associates, run by Ray Dalio. He's been doing it for 28 years, and over that 28 years, his return has been 11.5% versus a Standard & Poor's return of 7%. So he's beating the Standard & Poor's by about 4.5%. That's a whole lot less than I talked about if you miss the 50 worst days. Missing the first 50 days would have been a return of close to 22%. Dalio is one of the very best. He's getting 11%. By the way, the returns of Adams Financial Concepts are very close to that, and I'm going to come back and talk to them about that later in the program. Dalio runs $160 billion, and he's reached that level by doing that for 28 years. That's the kind of competition that you face when you're running and trying to execute a tactical strategy. And a lot of people do. It sounds reasonable. It sounds logical. Just to miss the worst days doesn't sound that hard, in fact, does it? Just to be out of the market. When the market goes down, just to be out of the market. You know, they asked Will Rogers one time what he would do, what his model was if he was going to invest in the stock market. What stocks would you buy? And he said, I would only buy stocks that go up. And they said, well, what if they go down? He said, I wouldn't buy them. You know, timing the market is basically that. You've got to guess which stocks are going to go up and which are going to go down. Tony Robbins probably stated the obvious more effectively than anybody that I know. And he stated the obvious, given the competition in the market, if you're a tactical investment strategist, this is what you face. And I want to quote. He said, timing the market is basically playing poker with the best players in the world. Timing the market is basically playing poker with the best players in the world. Those players play round the clock with nearly unlimited resources. They have the computers, they have the people, they have almost unlimited resources. Ray Dalio brings in $160 billion managing that. Just at 0.5%, you can figure out what his revenue is and what he's spending. He goes on to say there are only so many poker chips on the table. It's a zero-sum game. So, he says, so to think you're going to take chips from guys like Ray Dalio is more than wishful thinking. It's delusional. To think that you're going to take chips from Bridgewater Associates, if you're going to beat them, he says it's more than wishful thinking, it's delusional. He goes on to say there is a world game going on, and only a handful actually make money. And they make a lot by taking chips from the players who aren't as good. Think about where you fit in that criteria. And he goes on, finally, he finishes by saying, as the old saying goes, if you've been at the poker table for a while and you still don't know who the sucker is, It's you. That's tactical investing. That's why I stay away from it. I'm a mathematician. I look at algorithms. I look at things that are being done, and I see the returns that people are achieving, and I see the losses. I believe that this is really true. Let me say it one more time. Timing the market is basically playing poker with the best players in the world who play round the clock with nearly unlimited resources. There are only so many poker chips on the table. It's a zero-sum game. So to think you're going to take chips from guys like Ray Dalio is more than wishful thinking. It's delusional. There's a world game going on, and only a handful actually make money. And they make a lot by taking chips from the players who aren't as good. As the old saying goes, if you've been at the poker table for a while and you still don't know who the sucker is, it's you. That's from Tony Robbins, and I think that really summarizes what is tactical investing. It looks good. You know, you can look at a chart, and if you look at the number of people that are producing newsletters and the number of money managers who are out there, I go to the Money Show, and I can tell you at the Money Show, there's numerous people that are talking about how to make money in the market, how to see buy signals, how to see sell signals. Very few, if any of them, actually perform as well as Ray Dalio. They might for a short period of time, and I've seen people do it for a year or two, and then it all collapses because they don't have the resources or the money. Most people listening to this program don't have the resources or the money to compete on that level. So what's left? What's left is strategic investing. That's where I am with my clients. Those are the returns I'm getting with my clients. That's where we are. And so I want to take time in the next segment to talk about strategic investing and the key assumptions, the key parameters that are important for strategic investing, because I believe that's where individual investors can actually win, where they can grow their investments, and where they can make the money. And as validation of that, I can tell you that, and my numbers are posted, the composite of my clients is actually doing better than the Standard & Poor's 500 with dividends reinvested, and they've been doing that over 16 years. Not every year, not every quarter, but over the long term. That's where we are. So stay around. I'll be right back to talk about strategic investing. So I've been talking about investment strategies. I talked about asset allocation. I talked about tactical investing because those are actual strategies. I know that asset allocation is not considered a strategy. They talk about it being tactical or strategic, but in fact, it is a strategy with a focus. Do not lose. Tactical investing is a strategy to see that you miss the worst trading days or the worst trading times. I think that it makes more sense to do strategic investing. And if you missed my last segment, it's really important to understand. Strategic investing. There are three underlying principles or three key objectives. Objective number one is owning rather than winning. You know, when you talk about buying a house, your criteria of buying, you do inspections, you think about living there for a long time. That's as opposed to renting a house where you just want to find a place where you can lease it for a year and then walk away. That's the difference between strategic and tactical investing, is the difference between owning and renting. The second objective is understanding the power of compounding. Now, Einstein said it's the most incredible thing in the world. Didn't say it quite that way, but he said, if it doesn't work for you, it works against you. Understanding the power of compounding is a key of strategic investing. And the third objective is understanding that the market in the short term is inefficient, but in the long term, it's efficient. So you can find inefficiencies today that are going to be resolved in the long term. That's what strategic investing is about. Those are the three objectives. And as I talk about those objectives, it involves doing due diligence. Unlike the tactical investing, it involves digging deep into the investments which you do. And I'm going to talk more about what I do when we come to that, to give you an illustration of the work that goes into it. It's not an easy process. It's not a simple process. It's not just listening to somebody talk and give you the story of a stock and then going out and buying the stock. It's actually doing the due diligence. It's research. It's involving the research and forecasting what you expect the future to hold. And nobody knows for sure what the future performance is going to be, but it's coming with a probability of what's going to happen, and then assessing that probability on an ongoing basis. And it is, in fact, seeking alpha. It's seeking returns over and above market returns. That's the focus of strategic investing. And if anything, understanding compounding is crucial for strategic investing. Understanding, remember I talked about 500,000 asset allocation. Strategic investing, 500,000 at 15% in 25 years, 500,000 will grow to 16,459,000. 16 million, 500,000 grows to 16,459,000. If it's at 10% for 25 years, 500,000 will grow to 5,400,000. And if it's at 5%, the asset allocation, that 500,000 will grow to 1.5 million. Understanding that difference, the difference of 5% doesn't seem like a huge amount. 5% to 10% to 15% does not seem large, but the difference between 5% and 15% is a difference at the end of 25 years of having 1.5 million or 16 million. It is crucial to understanding the reason for strategic investing. Remember, in the first segment, if you were listening to the first segment, I said that talk about that $339,335. That was actually in the second segment when I talked about the Holy Grail of growing beyond the Standard & Poor's, growing 330,000 to 5 million. Oh, what we've shown is we haven't seen anybody that's been able to miss all the best trading days. You see them hitting bad trading days and missing good trading days. So if you just stay in the market, this is an illustration I've talked about any number of times. And again, I've taken the information from the Stock Trader's Almanac, Jeff Hirsch. I'll give him a commercial about this. Do go out and get the Stock Trader's Almanac if you're doing your own investing. It's just loaded with information which is really useful. And some not so useful too, but a lot of it is really useful. So growth of 100,000 invested in the Standard & Poor's and getting all the best days and all the worst days. You can grow 100,000 over that 20 years from 1994 to 2014. It would have grown to 339,000. Threefold increase. But if you miss the 10 best trading days, it's just one day every other year. Instead of 339,000, you'd have 119,000, less than half. If you missed the best 30 days, 1.5 days per year, instead of having a positive return, you would have lost money. And if you missed the 50 best trading days, not only would you have lost money, you would have lost over half of the money you had. So staying in the market is the focus of strategic investing. And when you look at the great investors of the 1900s, of the late 1900s, if you look at Warren Buffett, if you look at Peter Lynch, if you look at John Templeton, if you look at Roe Price, if you look at Philip Fisher, they all produced outstanding returns. Warren Buffett, for a couple decades, produced 30% a year. Peter Lynch produced 29% for 13 years. Templeton produced 15% over his career, and for a period of time over 20. So did Roe Price, and so did Philip Fisher. Even though their long-term performance fell short of the 20% per year, for a period of at least 25 years, they were over 20% per year. Think about it. Every single one was a strategic investor. Every single one had a different approach. Buffett's approach was to buy and hold and never sell. Peter Lynch's approach was looking at growth versus stock price versus PEs. John Templeton was an investor in Japan. Roe Price and Fisher looked at stocks. They each one had a separate approach to strategic investing. And I can tell you, my returns are not that different from theirs, and my approach is different from all of them. And even if you look at the people that were considered great traders, George Soros. Oops, I need to take a drink of water. I'll be right. If you look at people like Soros was the man who got the reputation in 1992 as the man who busted the Bank of England because he shorted currencies. If you read his history, you'll find out that he's a person who talks to central bankers. He will make recommendations to central bankers. It's almost like insider trading. So just why don't you buy 15 billion or $15 trillion of this? And they do that. And he's able to buy the currency, do the trades. He's a very special investor, something that no one that I know of can do the same thing. But he's not a trader. He's not trying to call the down times in the market, the up times. He really focuses on changes. Jim Rogers made a huge bullish commodities call. He's not trading in and out of the market. He made his money with the bullish commodities. Paul Tudor Jones, considered one of the great traders of the last century, he shorted stocks in 1987. That's where he made his money. Not that he was calling the ups and downs over a long period of time, but in a very short period of time, he made the right trade. John Paulson, another of the great traders, he bought credit default swaps on the housing crisis in 2008. That's where he became. David Tepper went to Carnegie Mellon, by the way. Tepper was one of those people who buys distressed securities. They're not people who are, I would not consider them actual tactical investors. I consider them more focused on an individual part of the market and doing well. I think for strategic investing, it's a matter of doing due diligence. It's a lot of work. It's a lot of hard work. I hate to say it's a lot of hard work because I love the work. But I'm going to give you an example when we come to the next segment of what I do, because my returns are better than the Standard & Poor's 500. Eugene Fama shared the Nobel Prize by showing fewer than 7% of money managers earn their fees, means that their results equal to their fees, equal the benchmark, and fewer than 1 or 2% actually outperform. I'm in that category. My clients are in that category. We're going to come back after the commercial break and talk about what I do and give you some insight into the due diligence and the work that goes on. I've shared this before. I'll share it again. I think it's important to understand what's involved in achieving outstanding returns over a long period of time. So don't go away. We're coming to a commercial break, and I will be right back after the commercial break to go through what I go through. So I've been talking about investment strategies, and I believe if you're going to have success as an investor, if you're going to be building your wealth, you have to have a strategy. And I talked about asset allocation. with an assumption, a rule, don't lose money. I've talked about tactical investing, which if people could actually predict correctly and be out of the market on the worst days, they can make a ton of money, a lot more than what I'm making. But the fact is, I don't know of anybody that's done that successfully. And even the very best people have unlimited resources or taking money from the people who don't have those resources. So strategic investing is what I do. It's what my bias is. And there's a reason for it. And I believe that the great investors have been, for the most part, everything that I've seen, they have been strategic investors, even those who have been called traders. So I want to talk and give you my example. Everyone who's a strategic investor develops their own strategy and own philosophy. I just want to give you an example, my example of the work that goes into being a strategic investor, because I believe there's a lot of due diligence that takes place. For me, it's looking at 30 to 40 stocks a month. And in the last 2 months, I've been short of that. I've had a lot of other things going on, but I look at 30 to 40 stocks a month generally. And of those, I drill down on 8 to 9, and I look at the financials, and I look at how they're doing financially. And then I do a deep dive on one or two. I read the 10Ks and the 10Qs. And if you've ever looked at a 10K or a 10Q, they're like 250 pages long. They talk about the risk in the stock. They talk about the competition. They talk about their accounting and their accounting procedures. They'll talk about the business of the company. They disclose a whole lot of things. And because of the profit sharing accounts, because we're doing shorts in the profit sharing accounts, I'm looking for specific things in those 10Ks and the 10Qs. I'm looking for red flags, things that don't sound right, but things that aren't right, things that raise deep concerns about the company. Because I figure if I can find one or two red flags in the 10Ks and 10Qs, there's probably 4 to 6 more that aren't disclosed. So that's what I'm looking for, though. I'm looking for the notes. I'm looking for the footnotes. I'm looking through 250 pages of 1 or 2 stocks a month. Sometimes it can be 400 or 500 pages. That's what I do. That's what I enjoy. My family thinks I'm kind of crazy for doing that, but that's what I do. And then once I do that, I only do 1 or 2 trades a year. 1 or 2 trades a year. I'm not a big trader. For certain accounts, I will sell a little bit here to meet their fees or to meet their requirements. But that's the research that goes into it. And I'm trying to evaluate those companies. I would like to have them to have twice the upside inside. What that means is I would like them to have the probability, at least an equal probability, of doubling or decreasing by 50, the risk of decreasing by 50%. There's a reason for that. If you buy 3 stocks and each one costs you $10 per share, so you're out of pocket $30, and if those stocks have the potential of going to $20, doubling in price from 10 to 20, or the risk of going from 10 to 5, and if 2 of those stocks don't work out, 2 of those stocks go from 10 to 5, but one does work out, it goes to 20. When you add 20 plus 5 plus 5, that's 30. So you get break even if you're right a third of the time. And I'm right at least half the time. So my returns are very good. That's the first principle. My portfolios tend to be concentrated. They don't tend to be, they are concentrated in 8 to 10 securities. And there's been a lot of academic research since 2000 showing that that's an improvement. If you look at even Thomas Howard, an economist out of Denver, talked about and looked at the commitment for mutual funds. If you look at their top 10 holdings, you'll see that almost all mutual funds, stock mutual funds, if just their top 10 holdings do better than the market. So those are their high conviction stocks. To meet their requirements, to diversify, they have 300, they have 290 more stocks or whatever, and those break down the performance. So it's high conviction. We're looking for companies which are highly focused and high performers. That's what I'm looking for. Companies that can do well and can make a difference in client portfolios. The third thing I do is I diversify over 8 or 9 stocks. And William Sharp, who received the Nobel Prize, in 1972 did a paper showing that there's no statistical difference between owning 8 or 9 stocks and owning 300 stocks. So we own 8 to 10 stocks in our portfolio. That's the due diligence. That's structuring the portfolios. And for every client, I structure the portfolio separately and individually. And I'm looking, as I look at stocks, as I look forward, I'm looking for stocks which are going to benefit from changes in technology. They may be technological stocks, or they may just be benefiting from changes in technology. Or they